Bank of America New York Stock Exchange back said that the 10 market rules of Wall Street legend Bob Farrell of Merrill Lynch are still relevant even decades later when stocks are falling due to rapid inflation and interest rate hikes, writes Business Insider. The rules for investing in the stock market, laid out by Farrell in 1998 when technology stocks dominated the market, sound plausible decades later amid the ongoing sell-off. A pioneer of technical analysis, Farrell outlined his 10 rules for investing in the stock market in a 1998 note at the end of his 45-year market career. And although they went unnoticed during the dot-com bubble, they gradually gained recognition since many of the rules set out by them corresponded to reality when the stock market was falling from 2001 to 2003. Any market tends to return to the average value over time when trends go too far in one direction. Investors should prepare for some trend reversal and return to the average value. Excess in one direction leads to further excess in the opposite direction. Sometimes a return to the average value is not enough. The market can swing like a pendulum, with excessive movement in one direction and then in the opposite. The example of cryptocurrencies will be the most relevant here. They grew 12 times in less than a year before losing 77% in less than 6 months later. There are no new epochs on the market when surpluses accumulate. We begin to hear the phrase "this time everything is different." When investors talk about a new era, the biggest move in the market has most likely already been made, and the mood is too extreme for this step to be continued. An exponentially rising or falling market usually continues further than is commonly thought, but it is not corrected. Parabolic rallies, asset bubbles, manias and crashes correspond to this rule, and as an example, we can recall the 70% drop in ARK Invest's flagship ETF. The public tends to buy the most at the peak and the least at the bottom. Such a paradoxical view of things can also bear fruit, and today, for example, individual investors are the most bearish about stocks since the Great Recession. Fear and greed are stronger than long-term determination. Fear and greed usually cloud emotions and lead to incorrect investment decisions, such as selling at the bottom and buying at the peak. The market is strongest when it is wide and weakest when it narrows to a handful of blue chips. Broad rallies can last for a long time, while narrowing rallies are prone to failure. The bear market has 3 stages. A sharp fall, a reflex recovery and a protracted fundamental downtrend. Applying this rule to the current market situation, one can see the cyclical nature of the bear market on the S&P 500, which is in the phase of a fundamental downtrend with the potential to decline to 3,800 and 3,500 points. When all experts and forecasts coincide, some other and unexpected event will happen. This rule assumes that consensus among experts is often not fully taken into account in asset prices, which is a risk that forecasts will not be justified. A bull market is more fun than a bear market. It's quite simple here. A bull market is associated with economic growth and the positive effect of wealth, while a bear market is often associated with a recession.